Hello. So IBM is a company that I've been holding for a while now, and it seems to be trading sideways. So you will see here that the company stock price hasn't moved much. It's been trading at about a range of 100 to 150, going up and down, and hasn't really moved much till that time. Now, you would kind of expect that if you take a look at the dividend yield of the company, which is 5%. That's a very hefty dividend yield. And one of the first things that we're going to take a look at is the dividend payout ratio, just to make sure that the company can actually accommodate paying this kind of a high dividend yield. Now, first things first, the market cap of the company is $115 billion, and the shares outstanding being at 900 million, they are actually going down, which is something that I love to see. IBM believes that the stock of the company is undervalued and it's buying back shares, and I absolutely love that because as an investor, you want the share number to go down because then your shares gain more value regardless to the overall market, in this case the company's outstanding stock. So these are some signs that are looking good. And the other thing that's very, very interesting is that the current PE is 25, which is fair for such a company. And the next 12-month PE is 12, which is half of it. So it's projected that the company is going to be making much more than the current stock price is, which is great to see. And the price to book ratio is also fair, sitting at around 5. Let's take a little bit of a closer look at the dividend yield first. Now this is interesting here because the payout ratio is 122%. So that's a lot. The company is spending a lot of money and cannot really sustain the dividend, it looks like. So I wouldn't be surprised if at some point the company actually cuts down on dividends. And so that's something that is a little bit worrisome. And if that happens, you may see a sudden decline in stock price. And based on what's been happening here, the company's dividend yield has been growing over the years, many years really. And the payout ratio is actually more than 100%, which is again a little bit worrisome. And so I would be a little bit, worried about the potential dividend payments, and maybe I'd want them to make sure that the payout ratio is actually lower before actually, deciding to invest more money in this company. The good thing about it is that if you get a 5% yield, that's a pretty nice yield. And so in like 5 years, you can make 25% of your initial investment. So that's actually great. Probably you're going to make a little bit more just because of the company's stock price, probably. But let's take a look now at the actual income statement of the company, the financials really. So here we'll look at the income statement and always look at like 5 years, a 5 year period. I think is fair. Now this is a big problem with IBM. There is not much growth, and this kind of growth here, which is kind of negative, points to a company that's not growing. It's basically steady in terms of growth. And so you should be expecting the same amount of gross profit, the same amount of net revenue, and this can be okay in some situations because if you gain $5 a year, you know how much you're gonna gain and you're not losing money. You have a bank there so that it's expanding its cash flow, but you know also that there is not much growth over there. So in the stock market nowadays, people expect growth and people tend to buy growth, and so you can have a nice bank over here paying you some money, but it may be a little bit tough to actually make money out of it in the long run, just because not many people will decide to invest in companies that do not grow at much potentially. And so you'll see here that the net income of the company has been going up till 2019, but down at 2020, and lately it's sitting at 4.7 billion, which is concerning to see. I mean, the company has been dropping in terms of assets. Never a nice picture, really. So the balance sheet of the company over here, you will see that the total equity of the company seems to be growing. And again, it's growing nicely over here. Now, what we do know already is that the company hasn't been issuing shares. So maybe they have been getting some debt. And you will see here that the long-term debt that the company has been taking seems to be increasing as well. Now, looking at the cash flow can give us a little bit of a deeper detail actually on what's going on. The nice thing about cash flow from operations is that it's kind of steady. And again, you could kind of expect that because the company doesn't seem to have any growth really. It's like the same thing every year. And with some mild minor differences here, but overall it's about 16 to 18 billion dollars, about that range. And the cash flow from investing, company seems to be investing in some capital expenditures and acquisitions. That's normal. And over here, interestingly, you'll see that the company is actually paying back a lot of debt, and it's still getting some debt over here, but it seems to be balanced. Like it seems like they're getting as much debt as they are paying back, and this has to do mostly with 2019, where they actually got a lot of long-term debt, really. But then they seem to be repaying it back nicely, and also repurchasing some of the common stock. This is why you're looking at a company that's actually decreasing its float and its outstanding shares, which is awesome to see. Free cash flow over here, 13 billion, 11 billion, 12 billion, 15 and 13. And so this cash flow is actually really, really good. And the thing is, if you take it, let's say that it is like a $12 billion cash flow, multiplied by 200, by 20, and you get it to about $200 billion market cap. So this points to a company that's making enough money to sustain a very, very nice market cap projection of multiple of 20 free cash flow. And so right now the company is at about half of that. So again, the company, if you picture a company that's making like $10 billion, it's actually more than that, obviously. It's about 13. But let's say that the company is making $10 billion a year on free cash flow. You multiply it by 20, you get $200 billion for the expected market cap. And it's 115, so the company is at 50% of what you would expect. This could potentially point to a stock that's actually undervalued in terms of its price. And it wouldn't be weird if the company's stock price went to 256. At that point, even at that point, the company's free cash flow would point to a company that's normally valued. So right now it looks like IBM is potentially an undervalued company. And this is why one of the reasons why I bought IBM. Now, I understand that some people don't really like dividends, and there is a lot of bit said about that. I mean, dividends is sustainable income, but in some situations, I also am not a fan of that. I do like companies that grow, and IBM seems to have a little bit of a stalling growth, and it's not great to see. But I cannot avoid the fact that the company is making boatloads of money, and that's at the end very, very important, obviously. And so the solvency here is very, very high, is in terms of the total debt, and this has been an issue, obviously, and it's something that IBM will have to battle with. The company has a lot of debt. That's a substantial amount of debt, and this is why they cannot sustain their payout ratio. And so, if we are talking about the company in terms of cash flow, the company is making a lot of awesome money, but they are very, very leveraged in terms of debt. And I'm not really sure why they are not looking to cut down on that debt. Maybe that's the way they operate. But this kind of financials here kind of point me to a little bit of a weird management situation here, because it looks like the company could actually pretty easily pay back some of its debt, yet it doesn't decide to. And that's a little bit surprising. I'm not really sure why they do that. The problem is this can really hurt the company, and this can actually bring the stock price down even further. I don't know what they are thinking about here and why they're doing this kind of thing. But on the other hand, again, the cash flow of the company is amazing. I mean, the company is making a lot of money, so I'm not entirely sure why they are that leveraged and they don't just decide to remove some of the debt. You will see on their balance sheet here that the total, and we discussed that, the total equity of the company is more than enough to actually start removing some of the debt. So I'm not entirely sure why they choose this path, but this is what's going on. Now, it's a bit of an interesting situation here with IBM. Would I actually buy that company? Now, I own the company, so obviously I bought it. But would I buy it today, based on what I'm saying here? Well, it's not a certain buy for me. I mean, and when I actually bought the company, it wasn't a certain buy back then. I just did like getting a little bit of income back, so I kind of bought it for dividends, and also the fact that they have great cash flow. Yet I understand that somebody doesn't like the growth situation and the debt situation. And again, the company seems to be well versed towards actually removing some of the debt, yet they don't decide to. Again, a little bit weird. However, they do drop their outstanding shares count, which is nice to see. And they seem to be undervalued and probably massively undervalued based on the free cash flow that they are making. And that, in the end, is the most important thing for me. So I do buy IBM, but I don't go all in on it. That's what I wanted to say about IBM. I do buy a little bit to have some nice sustainable income, being a little bit cautious about the dividend because the payout ratio is very high right now. Regardless, I think they can sustain the dividend based on the free cash flow. And I'm being a little bit cautious. I would add a little bit of IBM to my portfolio today, just because the companies are undervalued based on the free cash flow that they're making, and they're not diluting shareholders. So that's what I had to say about IBM. If you enjoyed the video, please leave a like and subscribe, and I'd love to see you in the Discord channel that we have created for the channel, for the YouTube channel. So there's a dedicated server in which we are discussing about all sorts of investment topics, and I'd love to see you there. And I'm adding a link to the description here, and also you will see the link to the Discord video, which talks about the channel, on the top right of your screen, the video actually. So thank you for watching, and I'll see you in the next video. Bye bye.